Hey everybody, my name is Jake. Welcome to the channel. In today's video, I'm going to be reviewing a few subscriber portfolios. I've done a similar video like this a couple of weeks ago, and I think going forward, I'm going to try to do a video like this every single month. So if you're interested in me reviewing your pie, or from a different brokerage, whether it be from Robinhood, Schwab, whatever, Vanguard, send it over to me with a few pieces of information, like who you are, your age, what you're trying to accomplish. What I mean by that is like, what are your goals? Why are you investing in a dividend growth strategy? Why are you investing into the companies that you're selecting? And so that I can add a little bit more context when I review your pie. And really just keep in mind that I'm just a guy here on the internet down in Austin, Texas. I'm not a financial advisor. I'm just some random guy, right, that shares his portfolio on the internet. I use M1 Finance. As you can see here on your screen here, this is my dividend growth portfolio. I've been investing in this portfolio here on M1 since about the middle of last year. I transferred over my portfolio from Robinhood, and since then I've been dollar cost averaging into the market. And really the key here for me, what I've learned, is consistency. I've been transferring over into my portfolio every single week. I have two portfolios. I have a real estate focused portfolio and my cash flow portfolio. That's what I mainly share on the portfolio or on the channel here on YouTube. I have shared other videos on the real estate one. So if you're interested in that, you can check out some of my previous videos, and I will continue to share more updates on my real estate slice, because I've actually made a few updates, not in terms of holdings that I'm invested in, but rather how I allocate or have my target allocation set up. But really, my investing methodology or process has been that way for some time now. And really, I'm dollar cost averaging in my portfolio, and I'm leveraging the dividends of my portfolio to then fund my portfolio. And really the goal here, my investing approach, is to one day achieve financial independence. There's a movement here on the internet called FIRE, Financial Independence, Retire Early. And that's what I'm striving to do. I have an investment property, a real estate, rental property that I'm investing in. I'm really trying to grow passive income or cash flow so that I can then slowly transition from my day job to support my living expenses, my mortgage, my utilities, whatever it may be, so that I can rely more on my passive income and not so much on my active income being my 9-to-5 job. Okay. And so really that's a quick intro to who I am as an investor. If you're a first-time viewer of the channel, that's kind of the mentality that I take. And so if you just stumbled upon this video for the first time and you're new to my channel, I'd invite you to subscribe if you're interested in investing into companies or ETFs for dividend growth, really to grow passive income or cash flow through dividends. Subscribe to the channel, follow along, and let's dive into today's video. Okay, the first portfolio that we're going to review today is from AJ. AJ writes, the review of my pie series is great. Thank you, AJ. Really appreciate it. The idea actually came from a Reddit post that I was viewing last year on the M1 Finance Reddit page. I was just seeing, kind of what people were mostly talking about. And I remember there was this thread regarding review my pie. And I think that was the most visited or upvoted thread on Reddit at the time. I haven't checked in a while, so I don't know what it is now. But I saw that there was a lot of interest, and I just kind of was thinking about, over the last couple of weeks of staying home, what could I do to kind of add more value to those of you here that follow the channel and kind of, involve the community a little bit more. And so that's why I started thinking, okay, review my pie. That's kind of a cool idea. And so this is something that I want to do here more often. But once again, I've said it again and I'll say it again and over again. I'm just a normal dude, right? I'm not a financial advisor. So what I'm going to be sharing in this video, don't take it as financial advice. Don't go put all of your money into necessarily into the things that I'm saying. It's just really my opinion, and I'm trying to take a a generic approach based off of the information that you're giving me, right? And that goes for everyone, whether in this video or in future videos. Okay, but let's take a look at it. So AJ, you're 20 years old. Your goal here is to create another passive income stream. Okay, great. You currently own a rental. So you're 20 years old and you own a rental and you're investing $1,500 a month into your portfolio. AJ, this is amazing. The fact that you're able to invest this much money, I'm just going to go out on a limb here and say, you're likely, I don't know you. I would assume that if you're 20 years old, you probably, and you already own a rental, it means you have really good influencers in your life. Maybe your parents, maybe your friends, whatever it may be, or maybe you're kind of doing this off on your own and whatever it may be, but you're able to keep your expenses low. If you're able to invest this much money, I would assume that you're keeping your expenses low. Maybe you live at home, maybe you don't, maybe you're house hacking or whatever. So this is so great to see. If you're doing this at 20, man, AJ, you're going to be able to retire, in your 30s if you keep this up. So this is really, really cool stuff. Let's take a look at your portfolio. It looks like you have 18 holdings in your portfolio, over a 4.5% dividend yield. I mean, that's a really good, strong dividend yield. And I can see that probably most likely because of the REITs that you have in your portfolio. A quarter of your portfolio is in the real estate sector. Now that's pretty high. Now considering you own a rental property, you're 20 years old, you probably have more exposure to real estate, especially if you're 20. If you're 20 and have a rental property, you likely have friends or family members that are in real estate. So that's really great to see. I think for your average Joe, somebody that is not maybe so real estate savvy, I would never recommend over 20%. But in your case, I mean, I don't know you, I don't know your particular situation, but that's kind of what's kind of going through my mind there. So when I look at your slices here, you got it very heavily skewed towards realty income. This is one of my favorite REITs. I own this in my portfolio as well, but 50% is pretty high considering your portfolio allocation here. You have 60% with SPG and realty income in the retail space. I personally like to diversify a little bit more within the real estate investment sector. One thing that I do like to see here is you don't have mortgage REITs. Mortgage REITs are focused on the mortgage aspect of the investment there. It's not investing in physical real estate. So I like that fact. But I think my overall opinion here, or my feedback that I would say, okay, well, consider maybe diversifying a little bit more. Now, if this virus continues to go on, and let's say realty income were to be forced to cut their dividend or suspend their dividend, which I don't believe that they will. I'm long on realty income, but it's kind of a high risk, high reward. That's how I view it there. Market ETFs, SCHD and VTI. VTI is my favorite ETF, market ETF. It's the most broadly diversified ETFs. I own this in my Roth IRA through Vanguard. And the SCHD, I also own this in my dividend growth portfolio, SCHD. I like also VIG and others, but these are two really, really solid ETFs. You could dollar cost average into this portfolio, into these two ETFs, and never blink an eye. Those are really, really high quality. Long-term holds, you got Coca-Cola, Caterpillar, Verizon, Home Depot, Microsoft, and Amazon. All great companies. I own 4 of the 6 here. I don't currently own Home Depot or Amazon, though, I mean, I could see myself owning them as well. Like, it's... Yeah. Coca-Cola at 25%. Now let's talk a little bit about your target allocation. Now, considering that you're 20 years old, if you're looking to tap into your dividends here in the next 5 or 10 years, probably more likely in the next 10 years, you want to consider focusing more on the growth rate of the dividend and not so much at the current dividend. Now, Coca-Cola has one of the highest current dividends, but they have a fairly low payout ratio, yeah, but they're not growing their dividend as fast as a Microsoft, for example. So consider that when you're picking or setting up the target allocation. In your particular circumstance, when you're 20 years old, you really want to focus on dividend growth. Don't fall trapped to the dividend yield. Yes, Verizon has over a 4% dividend. yeah, it's attractive, but with your age group, you really want to be focused on the dividend growth. Let's take a look at your financials. JP Morgan, Discover Card, and Wells Fargo, traditional banks. I think majority of people can wrap their heads around this. Traditional bank, what does JP Morgan do? What does Wells Fargo do? DFS, I personally own Capital One. I like Capital One just because I'm a consumer of their products and services. Another one that I really like is American Express. I've looked into Discover Card, and I think it's also up there. Something that you could consider adding to this would be Visa or MasterCard. Visa or MasterCard would be a very good fit to your portfolio. Let's take a look at your utilities, Dominion and Duke. Okay, 4.5% dividend yield. Now these are more your traditional utilities for current income. You may want to consider other utilities that are growing their dividend quicker, like Next Era Energy, ticker symbol NEE, American Waterworks, other such utilities that are growing their dividend a little bit faster. But that's just my opinion. It's up to you. Bonds in VCTL. So this is a corporate bond. I think it has a higher dividend yield. If I were to go with a bond, I would consider, this is one that I've considered. I've also considered BND. Or the international bond from Vanguard. I personally don't own any bonds in my taxable account. Now, something you could consider, if you're 20 years old, you said that this is in a taxable account. If you don't already, consider opening up a Roth IRA. This is not financial advice, just a consideration. And what you could do is you could then place the bonds in this type of investment. It would be more tax efficient in a Roth IRA. Now, the caveat there is you're not going to be able to leverage the investment until you're 59 and a half. So there's a give and take there, but that's something that you could consider. All right. Well, AJ, hey, thank you so much for sending over your portfolio. I think you know what you're trying to accomplish, and the fact that you're 20 years old, you're investing this much every month, you have a rental property, my hat goes off to you, my friend. All right, let's head on to the next one here. Josh writes, "Hi Jacob, first off, thank you for the videos you make and the knowledge that you share." Well, thanks, Josh. I initially started with Robinhood, and now I have an M1 Finance account as well. I remember you mentioned that you transfer your shares from Robinhood to M1. I understand that there's a $75 transfer fee from Robinhood. This is not from M1, this is from Robinhood. That's correct. I also read about how to transfer, and it seems pretty straightforward. I only have about $3,000 in my Robinhood account. I don't think I have any capital gains with the current market. I'm still not sure how to go about the transfer. Do I transfer the number of shares, or do I just sell out of them and transfer the cash balance? So I responded to Josh here in a more detailed response via email, but just really high level, with $3,000, you really could go either way. You could pay the transfer fee to get, to maintain your share price of these individual tranches that you have here, or you could sell out and then rebuy. But the thing there is you're going to have a few day waiting period. And so the market could go up and down. And so really ultimately you could go either route. And I responded to Josh here in a more detailed email, but that's really my response there. $75, it really, you can't necessarily, in my opinion, go wrong either way. So I think the M1 is a better platform for my goals and strategy, which is dividend growth, buy and hold and dollar cost averaging. Below is a link to my portfolio in M1 Finance. So Josh, first off, thanks for sending this over. I absolutely agree with you. I think M1 Finance is the platform of choice, especially for me, for dollar cost averaging and just putting your portfolio on autopilot. I have another portfolio with Vanguard where I very seldomly, make individual purchases when I see a company on deep discount, simply because I feel that purchasing individual shares is easier with a different brokerage than M1 Finance. I've shared this in the past. If you want M1 Finance, it's not really ideal for buying and selling. I don't typically, sell, but like to buy in at a specific price on any given day, you're better off with a different portfolio. And that's why I do both. I use Vanguard for individual purchases, which I do from time to time. But for the most part, I just I set up my portfolio and I just leave it on autopilot. That's really how I have it set up. All right, Josh, let's take a look at your portfolio. All right, so here's your portfolio. It looks like you have 75 holdings in the portfolio, just under 4.5% dividend yield and a small expense ratio. So you have some ETFs in here. All right, so you mentioned that you have $3,000 from your Robinhood portfolio. So with that, I don't know if you're intending to, how much you're intending to dollar cost average on a weekly basis and a monthly basis. 75 holdings is quite a bit. For M1 Finance's dynamic rebalancing, you're gonna need couple $100, in my opinion, a month invested to take advantage of the dynamic rebalancing of M1 Finance. That's just my opinion to really see the value out of it. But let's take a look and see what you have here. So you got your target allocation set up by sector. You got healthcare, financial services, energy, dividend aristocrats. So that's going to be spread out. You got consumers, utilities, real estate, communications, technology, industrials, dividend ETFs, basic materials, auto industry, and bonds. Okay, so Josh, if you're just starting out, I'm going to give you my opinion on what I think you could consider doing. I can tell right off the bat, if you have your portfolio set up this way, you're maybe just starting to learn to invest, you put a lot of thought into this. What I would consider is with this type of portfolio, you're going to be very tempted to change things. You're going to be tempted to add and remove slices, individual companies as you develop, as you grow as an investor. My 2 cents here is, I haven't looked at the slices yet. I would take this dividend ETF slice, I would bump this up. I would bump it up to maybe 30 or 40%. The reason why is when you're first starting out, it's a very emotional, I want to use the word game. It's an emotional game, right? You're investing in the stock market. It's volatile. It goes up and down. And if you're just starting out, I would highly, highly consider bumping this up 30, 40, or even 50% of your portfolio. The reason why is the psychological benefit that has, that okay, all right, you're invested for the long term, but when you're first starting out, you maybe don't know your risk tolerance. You don't know how you're going to react when you see the market drop 10, 20, 30, 40, 50%. But if you're investing into high quality in these ETFs that are not going to go bankrupt, right? They're going to go down in price, but guess what? You just buy more. But if you're investing into energy companies and you're investing more and more and you see that they go down, right? And you see maybe that Chevron cuts their dividend, for example, or ExxonMobil, and having the stomach to keep dollar cost averaging. So that's my first bit of wisdom. I don't really want to use the word advice because it's not really advice because I'm not an advisor. That's my first feedback there is bump up your dividend ETF. Let's take a look at what you got in here even. Okay, SPHD, VTI, VYM, beautiful. I love these. VOO, S&P 500, VYM. I own all 3 of these. I'm going to be picking up SPHD here in the future. But these 3 I own in my Roth IRA. I absolutely love these. And I actually recently on March 23rd picked up a few shares of VTI and VOO in my taxable account in my individual Vanguard account. So I'm invested into these as well. So for the sake of time here, just want to go through really quick and see, okay, some of the holdings that you have in your portfolio. Let's take a look at some of your dividend aristocrats that you have in here. You have 15. You got Lowe's, Johnson & Johnson, AbbVie, Pepsi, Aflac. Yeah, these are really, really high quality companies. These are really the cream of the crop when it comes to dividend growth companies. I like that you have ExxonMobil a little bit lower weighted down here. I like that you have Lowe's, Johnson & Johnson, Pepsi, these more growth-oriented companies allocated a little bit higher. I think having Procter & Gamble, you could even up that as well. So that's really what you want to look at. And so if you're in your early 20s or early 30s, you really want to focus on the dividend growth. If you're upwards of 40 or 50, that's where you want to look at more of that higher mid 3 or 4 current dividend yield with a 7 to 8 to 9% dividend growth rate year over year. That's kind of how I look at it personally. Okay, and so you didn't say your age or how old you are, so I can't really give any tangible feedback in terms of the allocation by sector and what that would look like. But really just overall feedback, what I would really look at is trying to keep it as simple as possible, especially with the economy the way that it is. Really focus on, okay, if the market goes down, am I comfortable with continuing to invest into these companies? And what I would also consider doing or recommend doing is go through and look at your companies and see, okay, do I know these companies? Am I familiar with them? Do I know what they do? Do I know what Sherwin-Williams does? Do I know what PPG does? Like, really understand, if you don't know what these companies do, consider revamping your portfolio and really focusing on your circle of competence. Circle of competence, you don't have to know everything, right? You don't have to know the ins and outs. You don't have to be an expert, but you should really understand, okay, what do the companies do? What am I invested in? And from there, you want to focus on, okay, am I comfortable with dollar cost averaging into these companies if the market goes down? Okay, and then the next step is following up on them, right? If one of them cuts their dividend, do you hold on to them? Do you sell out of them? What do you do? So with 75 holdings, it's a little bit more difficult. It's a little bit more time intensive when it comes to keeping up with your portfolio. It's not like, okay, throw in 75 companies in there and just forget about it. I mean, that's kind of the dream. That's what we want to do, but it's not really the case. And that's why, coming back to what I said earlier, when you up the dividend ETF slice, it's going to take away a lot of the stress out of that. All right, the next one is going to be here from Thomas. Thomas writes, I've been watching your channel for a few months. I've been investing for about 2 months. I'm 33 years old. I'm focused on dividends to possibly retire early or at least help support me along with my 401k when I'm older. Would like to accomplish as much as possible in the next 10 years. I plan on investing about $100 a week, but I keep some extra money on the sidelines to invest when there are deals, like now. By the way, even though I'm an investor, not a trader, I plan on selling the airlines and cruise stocks hopefully by the end of the year for profit. I'm not buying anymore. Thanks for your time. All right, Thomas, let's take a look at your portfolio. So you're investing with Robinhood. You have a little over $3,000. Let's see what you got in there. So you got SPHD. It's a great monthly dividend ETF. I've mentioned that in previous videos that I'm highly considering picking that up myself. ExxonMobil, AbbVie, Realty Income, 3M, McDonald's. All of these I own in my own portfolio. Amount of shares. Okay, 4 shares of AbbVie, 7 of Realty Income. Okay, good. Wendy's, I don't currently own Wendy's in my portfolio. I've looked into it in the past. I think really the only thing that's prevented me from picking up Wendy's was the dividend track record, but I'm a fan of their restaurant, their chain. AT&T, Pepsi, Coca-Cola, Microsoft, AG&C, and PSEC. So AG&C, I used to own the beginning of last year. I got out of AG&C simply because this is the riskiest form of REIT out there, the mortgage REIT. Because you're investing in the mortgage itself and not the tangible physical real estate. So I am not a big fan of AG&C. I sold out of it months ago, and I think you fall trapped to the yield trap here. AG&C is a very, very risky investment. I personally do not invest in it. PSEC as well. This is another mortgage REIT. And I think it has like over a 15% dividend yield the last time I checked. So this one, very, very risky. If you're just starting out, you're 33 years old, you want to maintain your capital, right? If you're investing for dividend growth, you want to ideally stay away from these type of investments. Those are not going to be the best investments for you long term if you are investing for dividend growth, in my opinion. Main Street Capital, good. Ford. I'm not a big fan of Ford. I'm not a big fan of the automotive industry in terms of investing for dividend growth. Ford is, in me personally, you can invest in a Ford, but don't rely on their dividend long term. That's my opinion. Look at their dividend track record. It's not something that you want to rely on going into retirement where you're reliant on the income. Just something to consider. American Airlines, high risk, high reward. Delta Airlines, high risk, high reward. The airlines right now, If they require bailouts from the government and the government takes control or takes partial control of their companies, it's not going to be shareholder friendly, at least in the short term. Who knows what's going to happen in the future? I currently own Southwest Airlines, but it only makes up a very, very small portion of my portfolio. CCL, I think, as you mentioned here earlier, I think these are really high. You might as well go to Vegas. I mean, I think it's a tragedy that's what's going on to them. I think cruises are amazing. I love cruises. You know, the experience that you have as a consumer, but as an investor, I'm not a fan. I'm not a fan of them. If you want to invest for potential growth, stay away from cruise lines. Take a look at, in my opinion, look at companies like Visa, Microsoft, MasterCard. Look at companies that if they go down in the short term, okay, great. But there's more upside potential. I think really the thing here is the opportunity cost. The opportunity cost is just so much higher with cruise lines. And this is once again my opinion. But if you're looking for that capital appreciation growth, you want to buy in and then sell them. Look at other sectors that, if you don't end up selling them because the market stays flat for 5 years, right? You don't come out, losing in that situation. So that's my opinion there. If you're going to take that approach, I'm not saying to go sell them tomorrow. I'm just saying that's how I personally view them. So Thomas, I hope that is helpful. I think something that I can share with you that I've done myself is, and I've shared this in the past, that I would recommend considering breaking up, maybe getting 2 portfolios. Have a portfolio purely dedicated to dividend growth if you're following this strategy, and have a different portfolio, a different account for your, I guess you could call it like Kramer, your mad money, where you're investing maybe for the capital appreciation. So that's how I would do it. It's helped me personally when I separate the two, where I have my dividend growth stocks and then I have my capital gains stocks in different buckets, different brokerages, so that I can focus on the strategies at hand. That's just merely my opinion. Thanks for sending it over, Thomas. I hope that helps. And all right, let's take a look at the next one. So Alex writes here, "Hey Jake, I started watching your YouTube channel pretty recently and I was interested in the portfolio reviews. I love for some critique on my portfolio." Well, hey Alex, thanks for watching. Let's take a look and see what you got here. So you're 20 years old. Your goal is to create a mainstream off of dividends over the next 5 years. 5 years is a very aggressive timeline. Monthly contributions. Okay, so you're going all in, $1,600 a month. That's a good amount in a taxable account. And let's take a look at your portfolio. All right, Alex, so let's see what you have in your portfolio. You got 46 holdings. You're just over 5.5%, no expense ratio, so you don't have any ETFs. Let's see how you have it broken down. You have consumer staples at 17%. I really like seeing that. Utilities, 16%. Right off the bat, 30% of your portfolio is going to be pretty recession proof, I guess you could say, where it's less volatile when the market goes down. Obviously, you're still going to be subject to market volatility because you're invested into equities, not bonds, for example. So you're going to have that market volatility, but not near as much as the broader market. Real estate, 15%, good, healthy amount. Healthcare, 14%. So let's take this. So 30% plus 14%. So you got about 45% healthcare as well. Sectors that are doing incredibly well in 2020, and they will continue to do well in 2020. So you got 45 plus tech, so you got 50% of your portfolio, which is off to a greater start than the rest of the market in terms of industry and sector. So 20 years old, the initial feedback that I would give here is technology. Bump up technology. If you're 20 years old, now if you want to use the dividends to pay off your living expenses in 5 years, okay, I can maybe understand that, but the likelihood is it's likely going to take a little bit longer to fully supplement your expenses and to not rely on your active income. So my feedback here would be consider bumping up technology much higher, maybe 10%, and lowering energy Heck, I would lower energy to maybe 2 or 3% personally. So that's just my opinion. That's what I would consider there. So let's take a look and see what kind of companies you have in here. This is once again your consumer goods. You got IBM. IBM's not really a consumer good. This would be more a technology company. Home Depot. This is okay. Royal Dutch. So this is actually an energy company. So this would go under your energy slice. Coca-Cola, McDonald's, Pepsi, and Costco. Okay, so it looks like you have a little bit of mixed things in here. So let me kind of share some consumer goods. There's two types of consumer goods. You have consumer staples and you have consumer discretionary. Consumer staples are those more conservative companies that everyone needs in good and bad economic times. Those are your household brands. Those are your Clorox. That's your Walmart. Companies, products, and services that everyone needs in good and bad economic times. Discretionary, those would be your hotels. That would be, your cruise lines. That would be, things that your entertainment, products and services that don't do so well in bad economic times, right? When people start spending less. So that's something that you can consider breaking that down in your portfolio because they perform fundamentally different in good and bad economic times. Your next one, utilities here. Let's see what you got. Dominion, Southern, Duke, Next Energy. So 4 of the 5 here I own in my portfolio. I like it. Something that you could look at are some of your water utilities, AWR, American Water Works. Those are some really, really hyper growth utilities that I own in my portfolio. Real estate, Realty Income, EPR, Wells, Store, LTC. I own 5 of the 7 here, the top 5 here. Realty Income, good retail one. 2 really high quality monthly dividend payers. Welltower is a good healthcare one. Store. So you're pretty skewed in your retail. Something that you can consider. Some of my favorite REITs right now are industrial REITs. Industrial, public storage, so storage units, and data centers. And also infrastructure like AMT, ticker symbol AMT. I like that as well. My favorite REIT right now is actually an ETF, VNQ. That is my favorite REIT. But after that, my second favorite is DLR, ticker symbol DLR, data centers. But really, for me personally with real estate, I always opt for quality over quantity when it comes to real estate. Healthcare, let's see what you got in here. Merck, Johnson & Johnson, MDT, United Healthcare, Amgen, AbbVie, great ones. I think me personally, I like Johnson & Johnson a little bit better than Merck. MDT is really good. Yeah, great. High quality healthcare companies. You can't go wrong with those. Finance, 7 holdings in here. Johnson & Johnson, Main Street, Bank of America, T. Rowe, Royal Bank of Canada, Aflac. These are great. Really, really great. Travel and entertainment, Disney, Delta, Carnival, Alaskan Airlines. Be careful is really all I can say with this. Be careful. Disney is by far my favorite of all of these. Airlines right now, it's a really risky play. I shared that here earlier in this video. I would really be careful with those. Disney, I'm a big fan of though. Energy, let's take a look at it. Chevron, ExxonMobil, NGG. Okay, if you're going to invest in energy, make sure it's high quality, quality over quantity. I like ExxonMobil and Chevron. Once again, I would really, really, really consider swapping energy and tech when it comes to the target allocation. Telecom, AT&T and Verizon, great, both in my account, in my portfolio. If you wanted to add another one, if you did want to, Comcast is another great dividend growth company. Tech, what do you got in here? Microsoft, Apple, Visa, Broadcom. Great. I don't currently have Broadcom, but I've considered it. I've really done a lot of research. I just haven't pulled the trigger just yet and added it to my portfolio. Microsoft, Apple, Visa, absolutely great. If you wanted to add another one in here, something that I've shared on my channel in the past is, for me, technology is a very difficult sector to predict the future. There's just so many disruptors. And so something that I've done is I've added a industry or a sector-specific ETF in the Vanguard Technology ETF, ticker symbol VGT. I'm a big fan of that ETF. It's a hyper-growth, dividend growth ETF fairly low expense ratio, but for me, that's really my focus when it comes to technology, with obviously Microsoft and Apple. So I hope that was helpful. Really, I think you're off to a great start. You're investing a lot every single month. Really, the key there is keeping your expenses down, side hustle, see where you can get some extra money, see if you can up that monthly contribution even more. The more you do that, the sooner you're going to be able to tap in and live off of the dividend cash flow. All right, let's take a look at the next one from Brandon. Hey, Jacob, I'm currently 20 years old and started investing about 2 years ago on Robinhood. I created an M1 Finance portfolio about 8 months ago because I really like the hands-off approach. Me too. And eventually I will move everything over to M1. My account is a normal taxable portfolio. I invest $100 a week into it. I plan on using my dividends to pay for expenses in the future, but for now, I will let the compound interest do all the work. Great. Love your channel and definitely have learned a lot from your videos. Your insight on my portfolio would be greatly appreciated. Well, hey, Brandon, thank you so much, man. I appreciate you sending this over. I do recognize the name. I've seen you comment on my videos in the past. Thank you so much for the support. Brandon is also a finance YouTuber here, and if you haven't already, go check out his channel. So let's take a look at his portfolio. Alrighty, Brandon, let's take a look at your portfolio. 47 holdings, just over a 4% dividend yield, a little expense ratio, so you got a few ETFs. All right, how do you have it broken down? ETFs, the highest target allocation, real estate, consumers, that consumer staples are discretionary, probably staples. Most people go with staples when they think of consumers. Healthcare, utilities, industrials, finance, technology, communication services, bonds, and energy. Okay, so initial comments here. I like that you have bonds low. I personally don't invest into bonds in a taxable account. I own the 60-40 portfolio from Vanguard in my Roth IRA, but just a very small percentage. Energy, 1%, technology, 5%. So if you're 20 and you got some time before you're going to be tapping into your dividends, I would highly recommend considering up and up technology. Technology it doesn't have a current high yield, but if you're not looking to tap into the dividends right now, you can't afford not to invest into technology. Whether that be, I don't recommend having it the highest percentage. I mean, if you're looking for a little bit of a higher yield, but I would definitely consider upping up technology. So let's take a look at your ETF slice. I like that you have it at 25%. VIG, VOO, SPHD, and SHD. Great. Very, very high quality ETFs. I love that you have VIG in here. SEHD, these are great dividend growth ETFs. I've talked about these in the past. VOO, SPHD, these are really high quality ETFs. And I really like the fact that you're 20 years old, right? You're just starting to invest here, just under a year, no, 2 years you said. So the thing that I like about having so much in ETFs is you can really do it, and it helps you keep your emotions at bay. If you have, and you're not investing into speculative companies, I'm assuming, I haven't looked at them yet, but I think it makes it easier, especially when you're first starting out or you're 2 years into investing, to stay consistent with it. So I really like to see that. What do you have in here for real estate, realty income, LTC, well, and medical? Okay, so huge fan of realty income, LTC, really good. Monthly dividend payers, Welltower. Yeah, I think the only thing that I would consider here is diversifying into different sectors within the real estate investment trust sector as a whole. Some that I would consider, I mentioned it previously, I really like industrial REITs. I like public storage REITs. I like data center REITs. So DLR, for example, and infrastructure with AMT, cell towers. Take a look at those. Those are really, really great REITs. Not a lot of those pay monthly dividend, but those are really high quality REITs. REITs that I personally feel very comfortable investing when they go down and averaging in when they go down. Let's see here. What else do you got? Healthcare. Oh, whoops. Let's go back here. Consumer. 14. So the bulk of your portfolio is in consumers. Pepsi, Disney, Procter & Gamble. These are all great. These are all great. Yeah, I love it. I love them. Healthcare, Johnson & Johnson, AbbVie, Omega. This is actually a REIT, but it's a healthcare REIT. Johnson & Johnson, 45%. This is what I'm looking for. Great. Utilities, Dominion, Southern, Duke. Great. These are your traditional utilities. Consider looking at more hyper growth utilities like Next Era Energy or your water utilities. They're growing a little bit faster. Industrials, 3M, Waste Management, Leggett & Platt, Caterpillar, Union Pacific. Great. I love that you have Waste Management in there. Okay, good. Finance, Main Street Capital, JP Morgan, Aflac, Wells Fargo, Bank of America. Main Street, yeah, good. I don't currently own Main Street. I've done a lot of research on them. I just haven't pulled the trigger yet. I like to see that you have Aflac in there. It's great. Wells Fargo, traditional bank, good. Technology, Apple, Microsoft, and Intel. Okay, good. One that you could also consider adding would be Visa. Now, I know Visa, finance company, but actually by definition, it's a technology company. You could consider adding Visa or MasterCard would be a really good addition to your portfolio. Communication services, Verizon, AT&T, great. I used to have my portfolio set up exactly like this. The telecom slice, I recently added about a half a year ago Comcast, great dividend growth company. Bonds, BLV, okay, good. If I were to invest into bonds personally, I would invest into BND, also a great choice. Energy, Chevron, ExxonMobil, love it. This is exactly how I have my portfolio set up as well. Love it. All right, very cool. So Brandon, I like how you have your portfolio set up. It's simple, it's manageable. You don't have too many holdings. You have it broken up in a very simple way. I really like, some people watching this video might be thinking, okay, well, 47 holdings, how is that simple? It is actually very simple the way that you have it set up. And I like it. It's a much lower maintenance portfolio than you would think. There's very few companies in here that you really have to be on the lookout. You don't have airlines, automotives, Carnival, like cruise lines. You're not really investing into companies that are at risk of cutting their dividend tomorrow. There's a few, a few REITs in there that you have to kind of look out for. But for the most part, you can invest into this portfolio and it's going to be very hands-off. Well, Brandon, thank you so much for sending this over. All right, let's take a look at another one here. Joseph writes, "Hello, Jake. I'm new to M1, began in January this year, and I got started because of your channel." Well, hey, Joseph, thank you so much for saying that. When I first came across the dividend investment strategy, it really caught my attention. The idea of having a big enough portfolio to live off of dividends versus adhering to the more typical 4% rule really struck a chord with me. So the 4% rule, for all of those of you that don't know that, the 4% rule is you're supposed to grow up a portfolio. Once you reach retirement, you're going to liquidate 4% of your portfolio. And the idea is that you're going to outlive your portfolio. Okay. And with the dividend growth investing strategy, you're living off of the dividends, and that creates generational wealth, and you're not liquidating the shares. Okay, Joseph Wright continues to write here, "Having said that, most of my retirement money is still in Vanguard index funds, and I intend to keep it that way, mostly because that's what my Roth 401k allows. Plus, I'm not confident enough yet in my ability to pick winning stocks." Hey, Joseph, absolutely fine. I actually started the exact same way. M1 is where my fun money goes, kind of what Jim Cramer says, your mad money. And I hope to add to it more significantly in the future. Even though it's not currently my main portfolio, I'm curious about what your and the viewers' thoughts are on it. Now, on to the M1 portfolio. The short explanation is, it's a list of my top 100 companies I'm comfortable owning for the next 30 years or so. I'm currently 30 at the moment. Each stock represents 1% of the pie. I know 20 to 30 stocks achieves appropriate diversification, but I had an extremely hard enough time cutting it down to only 100 stocks. My portfolio went through multiple iterations, so that's why a few companies that might not make sense with the dividend growth strategy, like Chipotle or Ford, for tax purposes, my REITs are in my Roth IRA, so the slice of the GICS pie become became the leftover of other companies I wanted to own but couldn't fit into other slices. I could go on explaining forever how the portfolio came to be, but I'll leave it at that. Hope everything I said makes sense and that you're staying safe. Well, Joseph, thank you so much for sharing this. I hope you're staying safe as well. A lot of what you're writing really resonates with me because I was in a very similar situation. I'm currently 33 years old. I've used many different portfolios from Vanguard to Fidelity to TD Ameritrade, Scottrade, etc., and was in a very similar situation when I first started using M1 Finance and investing in a dividend growth strategy. So let me share some of my thoughts with you. And once again, they're only my opinions, but let's take a look at your portfolio. All right, so let's take a look at your portfolio. You mentioned that this is not your main portfolio, that this is kind of your fun money, and you're investing. It may be like a hobby, or it may be something that you're still fine tuning. Okay, so let's take a look at it. And you mentioned that you had a hard enough time picking only 100 companies. There are a lot of great companies out there. Okay, so the way that I kind of look at this, especially with M1 Finance, is with the ability to break it up by slice and invest into fractional shares. Essentially, you're creating your own index fund. Now, the challenge there is you're not able to keep up and follow up with all of these companies. And if that is your ideal plan, then this is absolutely not the right, approach for you. But if you're investing side money, this is a hobby of yours, I say go for it. And let's take a look and see what you have in here. So you have it broken down by sector, financial services being the highest, technology, industrials, healthcare, everything else, defensive, consumer defensive, and cyclical, all at 10%, and then utilities, energy, communication services, and basic materials at 5%. Okay, so you mentioned that you wanted to keep everything at a 1% target allocation. So let's see roundabout what kind of companies you have in your financial services. So let's take a look at it. And they are all equally weighted at 5%. SPGI, love it. I have that in my portfolio. USB is a traditional bank. T. Rowe is in my portfolio. Some more traditional banks. Morgan Stanley, JP Morgan, Invesco. They just recently cut their dividend, if I'm not mistaken. I think they cut their dividend by like 50%, I think. So this is one of the risks of investing into so many companies and really having to follow up on that. So right now, what you were receiving in dividends last year, you're now receiving half of that this year because they recently cut their dividend. So that is one of the risks of investing into this type of strategy. And so you really have to be aware of that going into it. So if you're intending to live off of this portfolio for a big chunk of your retirement, you really have to understand, okay, what is my risk tolerance, right? And so understand that going into this, you're gonna be tempted to make changes to the portfolio. And in my experience with M1 Finance, it's not the most ideal platform for buying and selling. So if you're looking to make changes, for example, if you had the rule, okay, whenever a company cuts its dividend, like I do in most cases, I'm going to remove it from my portfolio. You're going to need to do a lot of homework and following up on these companies. So really understand that when you're going into this type of strategy. It may be a hobby now. It could later on become a burden going forward. So you have to really understand that. Okay, going back down here really quick, BlackRock, AXP. So really more established companies, larger companies, you're not investing into startups. So that's good to see. Technology, Visa, Texas Instruments, IBM, Broadcom, Oracle, Cisco, Intel, Microsoft. Okay, good. I mean, ADP, these are really high quality companies. Let's take a look at some of your industrials. I'm a big fan. I really like industrials. I like the track record of industrials. Historical returns are no guarantee of future returns, but I'm a big fan of industrials. I really like them. Waste management, great to see it. Granger, I actually was considering adding GWW to my portfolio. I ultimately didn't. I can't remember why I didn't add it to the portfolio, but that was also on my radar when I was first setting up my portfolio. UPS, good, have it in my portfolio. Union Pacific, ITW in my portfolio. The majority of these are also in my portfolio. So these are really good. Healthcare, you got a little bit of a mix of everything. Okay, so this is where, now obviously all of these companies are not created equal. I would not put CVS and Johnson and Johnson, like I don't view them equal. I don't believe that they are equals. In this portfolio where you're having everything diversified to a T, exactly the same, there's pros and cons to that. There's an opportunity cost to that as well. But for proper diversification, it absolutely makes sense. One thing that, the reason why I don't do my portfolio or how my portfolio is set up this way is because of that opportunity cost. If you look at ETFs, the majority of ETFs, there are a few exceptions. The majority of ETFs don't value all companies the same. And so there, once again, it comes down to that opportunity cost of, because I view Johnson & Johnson much more favorable than a CVS, for example, or Pfizer. But that's just kind of, there's different strategies, different approaches. For the sake of time here, I know that the video is coming up on nearly an hour, so I want to be respectful of that. I don't want to make the video too long. But moving on here, everything else, you got Southwest Airlines. I like it. It's in my portfolio. McDonald's. MasterCard, I don't own in my portfolio. I own Visa, but it's a great company I could see myself owning as well. Lockheed Martin, NVIDIA, great. Deere, Costco, Emerson Electric, great companies. Cyclical, VFC, Home Depot, Leggett, Target, Chipotle, man. Chipotle, they're doing really, really well right now. Chipotle and Domino's, man, they're dominating right now. Ford, not a big fan of Ford. I don't know. I'm not a big fan of the automotive industry personally. Let's take a look at your utilities. Great. I own all 5 of these. Great companies. Nexair Energy is probably my favorite utility. Basic Materials, Sonica, I love it. Nucor, Emerson. So Eastman Chemical Company, I own 4 of the 5 here. I don't own Eastman right now. I've considered it. I don't own it. I own companies like Ecolab and International Paper as well for my basic materials. But those are great ones. Energy, Valero, HP. HP just, if I'm not mistaken, they just cut their dividend, I believe, like really, really cut their dividend. Once again, that's the risk that you run when you add so many companies, having to follow up on all of your companies. Chevron and ExxonMobil. Me personally, Joseph, what you could consider is, I don't know, like energy, I have just 2% in my portfolio. Maybe considering breaking that down, but really that really comes down to you and your preference there. Communication, Disney, Verizon, Omnicom, Google, and AT&T. One that you could also consider here if you wanted to swap one out would be with Comcast. Comcast is a great dividend growth company. Defensive, I don't think we looked at that yet. Walgreens, Tyson Foods, Kroger, Cisco, Pepsi. Yeah, these are great. I read an article actually just last night that said that Kroger was at risk of their dividend being cut. I don't necessarily believe that. I mean, I would imagine, if anything, they're doing incredibly well right now. I don't own Kroger in my portfolio, so I don't follow them as closely. I just thought that was interesting. I know that they also recently got picked up heavily by Warren Buffett, so a lot of media attention on them right now. Okay, so Joseph, that's really my initial feedback there. I think, coming back to what I was saying, you run the risk of being over diversified to a certain degree. There is an opportunity cost. There's pros and cons to this type of strategy. Now, one thing that I would say is, you want to, if you're investing for the long term, you want to make as little changes to the portfolio as possible. Slow and steady wins the race. You don't want to be changing your portfolio up too much. And especially if you have this many holdings, you're going to be very tempted to make changes. Looking at your portfolio, 2 of the holdings that we just looked at, I know just recently in the last weeks, cut their dividend. So that's something that you have to be aware of. And if you plan on holding and sticking with these, regardless if they cut their dividend, this could be low maintenance for you. But if you're planning on following up on these companies, this is going to be like a second day job for you. If you take it serious and you highly rely on this portfolio to fund your living expenses in the future. I hope that is helpful. It's maybe not something that you necessarily want to hear, right? Because I know that you put a lot of effort and a lot of energy into picking these companies. setting up your portfolio. I know you're I know that you're very proud of it. You're excited about it, but just understand that that's going to be the reality, right? You just started here recently. You're going to be very tempted to play around with your portfolio, add and subtract, add things, take things out. So just be very, very aware of that and manage your expectations around that. So that's my feedback there. Thank you again, Joseph, for supporting the channel and for sending over your portfolio. Alrighty, everybody. Thank you so much for those of you that sent over your portfolio. I know that there was a lot of you that sent your portfolio here via email. I'm sorry that I wasn't able to review them in this video. I'm going to be doing more videos like this in the future. These are a lot longer videos than my other videos, and I can tell right now I'm losing my voice from talking so much. I really appreciate all the support. Once again, the comments made in this video are, once again, just my opinion. Do not take it as financial advice. I hope that this was helpful. I hope it really kind of inspired others. Maybe you're new to investing or you're a more seasoned or tenured investor. I hope that this maybe gave you ideas and provided some type of value to you. And if you enjoyed the video, hit the like button, subscribe to the channel. If you'd like me to review your portfolio in a future video, shoot me over an email. I'll leave my email in the description below and add a little bit of information, who you are, your age, your goals, how much you're investing to your portfolio each month, and I'll do my best to review it in one of my future videos. Thank you so much, everybody. Hope everyone is staying safe, and I'll catch everybody in the next video.